Hi, everybody. This is Dr. Gregory, and we are in ACC 4620 Auditing and Assurance 2. We're going to cover Chapter 6 in two parts. Part 1, this recording, is going to be on audit evidence. So when we try to think about auditing, we know it theoretically as the examination of books and records in order to form an opinion as to the fairness of the financial statements. But what is the evidence that we need to support those assertions that we're making as auditors? Well, basically, evidence is anything that we obtain and that we use to derive our conclusion. That's very simply put. And we can have a conclusion. We would have a conclusion for the financial statement and or the internal control assertions. So if we are looking at auditing the financial statements in order to determine whether or not they are free from material misstatement, that's the assertion we're making. And so we're going to find any and all evidence that we can gather that either supports or refutes that assertion. So when we're looking at the amount of evidence, it's kind of the auditor's professional judgment, but we're looking at two basic ideas. One, is it sufficient? Do we have enough quantity of evidence to support the assertion? And two, is it appropriate? Is the evidence that we have relevant in quality to support or refute the conclusions? So you want enough evidence to support it, but you want that enough evidence to be relevant to the assertion. And when you're doing testing in an assertion, for example, materially free from errors or irregularities, you're going to have to break that down. And we break it down usually by the entity as a whole, balance sheet and income statement, cash flow statement, and then we break down further the individual accounts. So sufficiency is going to be quite a bit, as well as the quality, making sure that the evidence aligns to the specific assertion that you're going to be making. As we said, it's got to support whatever the financial statement or the internal control assertions are. And it also has to be something that another auditor could go in, replicate your work, and come at the same conclusion. So we have to think about, well, how much quantity-wise are we having to look at? Well, if we go to Chapter 8, that will provide further details. So we don't cover that in this chapter. It does get covered in Chapter 8. But it has to be enough in order to create sufficient substantive testing. Now, for example, you would have cash substantive testing, accounts receivables, inventory, investments, fixed assets, accounts payable. You have to develop substantive sampling testing for every single account that you're going to look at. And we have to look at what is the risk of material misstatement. If you've got most of your client's business is in cash, it's a cash transaction, you would have more substantive testing in the cash account than you would have in revenue, correct? Because if it's a cash basis, you wouldn't really have revenue. Or you would have revenue that would match cash. So you have to understand what the industry is and understand what could cause that business to have material misstatements. We also have to look at the controls. And here I'm providing you with the COSO cube. And in the front are our 5 major controls. So we have to look at these controls and look at the risks associated with each control. For example, if the control environment is lax, if management is not proactive, if they are not walking the talk, then we have to say that there's a high risk that management isn't really telling us what's actually going on. And we would have to do testing in order to prove or refute that assertion. If in the control activities, for example, there was a lack of policies and processes and operating processes for how people conducted business, you would have to have much more substantive testing in that area, because you would have to be assured that everyone who handled, say, accounts receivable was entering and recording and reporting the transactions the same. And we know that if there's a lack of process documented, there's probably going to be a lack of cohesiveness of procedure. So we have to look at the risks associated with that control, determine whether the control is or is not effective through our tests, and what is the risk that material misstatement could occur. Well, if you have no processes and procedures in place and everybody is kind of the Wild West doing whatever they're doing, you could probably pretty much assume that there's going to be a high risk of material misstatement. So you're going to have to incorporate substantive tests in order to prove that out. Now, even though these are the components of internal control, these are also the control environments. So we want to look at the control environment, the standards, the processes, and the structures of management that carry out. We have to look at the risk assessment, identify and assess the risks of the organization. What are the policies and procedures of the organization regarding control activities? How is the company providing or sharing information? And finally, are controls functioning effectively through monitoring? Is the company monitoring and staying up on top of what they're doing to make sure the controls are functioning effectively? Now, once we have that figured out, the quantity and the quality of the audit evidence, now we have to look at the relevance or the appropriateness of the evidence. So you have to align what you're auditing with the assertion that is being audited. So you have to develop your substantive testing to make sure that those tests align with the control you're trying to test for. For example, if you're testing inventory amounts and existence, you would set up substantive tests to count the inventory and determine the inventory value. So we go in and we test inventory, even though there may be a period of time between when the company counted its inventory and when we come in to count the inventory. It should not be so much different that we could not do tests of inventory counts to see how close we are to what the company stated. If there's differences, then we want to find out what those differences were. If our number came to one thing and the company number came to something else, then we would have to look to see what transactions took place between their count and our count that would identify the difference. Another example, if you're testing for asset existence, you got to go out and look at the assets. If they say they have 100 cars in their fleet, you got to go out and make sure there's 100 cars in the fleet. Or you could use source documents, such as the payment of inventory, payment of purchase orders and invoices for a building, and then look at the title of the building to make sure that the title of the building is in fact in the company's name. There's a couple of ways we can do this. I call it the cradle to grave and the reverse cradle to grave. So in the cradle to the grave, Look at the beginning to the end. Well, the beginning usually starts out with the source document, purchase order. Then you want to see the invoice. Then you want to see the purchase order. Then you want to see the receiving report. Then you want to see the invoice. And then you want to tie that directly to the subsidiary ledger and or the general ledger to make sure that the account started at the beginning and is now sitting in the general ledger correctly. In reverse cradle to grave, you just do the opposite. You start out by picking a transaction in the subsidiary ledger and or general ledger, depending on your company. And then you go back and you find the source documents and you make sure that everything is aligned correctly. So one is called tracing, which goes from the source document to the general ledger. The second process is called vouching, going from the general ledger back to the source document. So we look at that as part of relevance. Another appropriate piece of evidence is direct and indirect evidence. Direct evidence is really easy. It's the bank account. It's the accounts payable confirmation that's coming from a third party to you, the auditor. And then you take that information and you go back and tie it to the account in the general ledger. You can do some indirect evidence, such as looking at how the accounts payable is recorded in the system. We take the invoice, we do these steps to verify that the invoice is correct, then we record it into the system, and then it appears in the general ledger. And what you do is you take that information, which is indirect evidence, and then you go test it. So you replicate the activity to see if, in fact, those steps are taking place, and you can do it by observation, or you can do it by replicating the process. Now, we looked at relevance. Now we look at the reliability. How reliable is the evidence that we're gathering? How did we get it? Where did it come from? More reliable is you observing the asset, you looking at the source documents, you getting the third-party confirmations and going back and testing them. Those are the most reliable. Less reliable, and I'm not saying it's unreliable, but it is less reliable, is inquiring the organization. So how many cars do you have? We have 100 cars. Great. I take that information and I create direct evidence by going out and looking at them, going out and finding them, going out and tying every vehicle to an employee. Reviewing original source documents is always best. It's less reliable to look at facsimile or photocopies of documents because people can alter that information. So even though they give that to you, ask them to get the source document because that's really what you want. And if you go to page 231 of your text, you'll see a list of more reliable and less reliable sources. Looking at the appropriateness again of audit evidence. Internal versus external documents. Well, internal documents, we have to ask ourselves a few questions. How secure are those documents? Can somebody go in and remove documents, alter documents, and no one would know? If you go into a big room and there's just folder after folder after folder of invoices or payment documents, how secure is that? Is there any motivation by management to manipulate the documents? Part of this would come from you interviewing management at the beginning of your audit, and you talk about the environment, and you talk about some of the mission, vision, goals, or expectations of management. If management's expectation is that they have to have a 10% increase in revenue, there is a risk that if management doesn't make that, something bad's going to happen. Either shareholder value is going to go down, people will sell off their shares or no longer feel comfortable with them, or management may lose incentive bonuses for meeting those projections. So if you've got risks out there like that, then you're going to have to look at, is there a way for management to manipulate the documents? We do that by looking to see, can management perform any overrides? You talk to employees. Has management ever come to you and asked you to alter or change something? Or have they given you a document to record that has no support behind it? Is there independence of preparing the documents to the recording of the documents? Segregation of duties. Do you have one person who has control over, say, receiving cash receipts from customers and posting those into the general ledger? And maybe that person also has overwrite capability to void or cancel debt. If you've got something like that going on, you have to say, internally, is the documentation here going to be that reliable? If we're looking at external reliability, that's where those third-party confirmations come in handy. And you want to make sure that when you send out that confirmation to that accounts payable that says, dear ABC company, I'm auditing this client and I need to know whether or not this is the correct balance. So could you please confirm the balance? So having that come to, and having it come directly to you, bypasses the ability of the company to intercept that information and create something different. The third part is, do you require the assistance of a specialist? Some industries, you're going to need a specialist. If you're auditing insurance pensions or retirement pensions, you're probably going to need an actuarial as a specialist. If you are auditing jewelry companies, you might need a certified gemologist to confirm the reliability of the data that you're going to be looking at. So in summary, we want to know what audit evidence is. And basically, it's anything out there that will confirm or refute our assertions. How much audit evidence is needed? Well, it has to be sufficient. How do we assess those control factors from the COSO cube? For example, how do we go about making sure that we have assessed the risks within the organization? What is the appropriate audit evidence that we need to confirm or refute those assertions? And what does it mean when audit evidence is relevant and reliable? And finally, what is internal versus external evidence? I hope that helps you for now. Be sure that you read the chapter and reach out to me if you've got any questions. Have a great week.